This video covers money growth, money demand, and modern monetary policy. Since the beginning of the semester, I suggested the idea that wouldn't it be nice if we could grow the economy in a nice, stable fashion. We wouldn't have inflationary booms, we wouldn't have busts with high unemployment, and we'd all be a whole lot better off if the economy was stable. In fact, if it was stable, we probably could even increase that trend line a bit. In other words, the fact that we've had destabilization in the past with booms and busts, it's probably lowered our potential growth rate. So I think we'd be better off if we could just stabilize things. An economist from the 1950s, Milton Friedman, what he suggested was pretty straightforward. He basically said, look, if the economy grows around 3 to 4%, why don't we just have the money supply grow at about 3 to 4%? We'd have stable inflation, stable money growth, and a stable economy. That's what he proposed. This was the 1950s. It sounded good. It made a lot of sense. But now in today's world, it's a bit more complicated. And that's what this chapter is about, trying to describe the relationship between money growth and modern monetary policy. And the link between them is money demand. So let me give you a quick, somewhat detailed summary of what this video is about. So we start out by covering the quantity theory of money. Okay? This equation links money growth plus velocity of money, and this is money growth plus the change in the velocity of money, equals inflation plus growth in output, real output. And so that's the key. This equation is the key to opening up this chapter. And we're going to ultimately, what we really want to do here is let's examine how changes in the money supply affects changes in inflation. It turns out not to be that easy of a connection to track. And the reason is this: the velocity of money, which appears to be unstable, kind of throws a wrench in the relationship between those variables, growth in the money supply and inflation. So what we're going to do is we're going to talk about these concepts. And what I want to do in the video is weave these concepts together. The quantity theory of money, this equation, we're going to look at money growth, and then money demand is also linked up and tied into this, because if we can better understand money demand, we can better understand the money supply and its growth. Why is that? Because lurking in the background is the idea that money supply equals money demand in an equilibrium. So let's flip over at times and look at money demand. And maybe that'll help us understand things a little bit better. Now, woven into this chapter is the concept of hyperinflation versus normal inflation. Now, you might want to ask, why the heck are we covering hyperinflation? We don't have anything near that at this point, and that's true. But around the world, we do have hyperinflation in some countries, and in the past, there was a number of countries had hyperinflation. So the point of covering hyperinflation is that when we have hyperinflation, we know exactly where it comes from. And it comes from a really high money supply growth. Basically, it's the printing presses operating. And so we have a direct connection between money supply growth and inflation. That's when we have hyperinflation. In other words, what it's telling you is that that wrench that I was talking about, that velocity of money, it's inconsequential when you have really high hyperinflation. But when you have normal inflation, like where we are now, what drives the story is that volatility in velocity. That's what's causing the problems. It causes a disconnect between changes in the money supply growth and changes in inflation. And that's important, because you have unstable inflation and you can't quite track it very well, then look here, that inflation rate drives interest rates. And we know interest rates having a really important effect on the economy. So we need to better understand this. And one way to look at it is, let's go to the Fed funds rate, going back all the way to the mid-1970s, right here, mid-1970s, all the way up to today. And so this is the effective Fed funds rate. And the point of this graph is right in this time frame here, 1979 to 1982, we had high inflation. That's why the interest rate, the Fed funds rate, was so high. But it was nowhere near hyperinflation. Okay? It was high. So it's relatively normal but high inflation. And in that time frame of 1979 to 1982, the Fed decided their goal was to get rid of that high inflation. And to do that, they targeted the money supply. They looked carefully and managed as best they could the money supply. And look what happened. When they controlled the money supply, look what happened to interest rates. Interest rates fell dramatically along with inflation, which graphically supports the Fisher equation's math. Not only that, but we see that interest rates were a bit choppy afterward, likely due to changing money velocity, but other things obviously were occurring at the time, like changes in GDP growth, changes in budget deficits and unemployment rates. So lots of other factors were throwing a wrench in that graph. So now we discuss, how do we actually conduct monetary policy today? We're not in a high inflationary environment like the early 1980s, so we can't look solely at the money supply like Milton Friedman told us. Looking at that's going to cause a problem because of the unstable velocity of money. So what we'll conclude at the end of this video, after going through all the material in this chapter, is that, well, what we should do is we should look at keeping a steady inflation rate. No surprise there. We should keep interest rates steady, and that comes about in part through stable inflation. And what we need to do is we also need to keep an eye on growth of the money supply. So we need to keep our eye on everything, really, and not focus solely on one particular item. And so the whole chapter tells us why we should be looking at all these various components rather than just looking at one component. So when you finish this video, you might ask, I wonder what causes what? Other than the idea that high money supply growth causes hyperinflation, the idea of causality is hard to pin down in this chapter. What drives what, and how do we systematically approach this problem of implementing monetary policy to control and stabilize the economy? Well, that's where the next chapter comes in. While I don't want to get ahead of myself by talking about the next chapter, I haven't even really gotten out of the introduction of this chapter yet. The next chapter is going to present a systematic approach with causality at its heart to look at output, inflation, and monetary policy. So with that in mind, let's jump into the quantity theory of money, of which the equation of exchange is the centerpiece. The quantity theory of money is best described with this formula: MV equals P times Y. This equation is the equation of exchange. Okay? And this Y is often denoted as Q in a lot of other sources. So here's what this says is, look, here's the money supply, M, that we've been looking at. Here's the velocity of money, which is a measure of turnover. How often does a dollar turn over in transactions? And that's going to equal, and what this boils down to right here is GDP, gross domestic product, nominal gross domestic product. So this is the price level, and then this is quantity, basically. This is real output, and the author's denoted as Y here, but think of it as Q, the quantity of goods and services produced times the price. That's GDP. Now let me give you an example so this makes some more sense. So let's say the money supply in a really simple economy is $2. The price level is $1, and there's 10 units of Y. In other words, the price of a unit of Y is $1, and so there's production of 10 units in a given year, and so therefore you have 2 times V equals 1 times 10. So it's 2V equals 10, V equals 5. In other words, this $2, which is in the money supply, turns over 5 times in order to have a GDP of $10 nominally. Now, what's important to this is notice what I did. I plugged in M, I plugged in P, and I plugged in Y because these are observable. We have estimates of this. This is not hard to get. What's hard to calculate is this V. How often do transactions turn over in an economy? That's what's unobservable. And so what we're doing in this chapter is we're looking at all these variables and then backing into what V ought to be, which is exactly what I did here. Now, that said, let's take a more easier let's do a transformation so we can better understand this. It's a little easier to wrap our head around. So let's look at the change, the growth rate in M, the growth rate in velocity, the growth rate in prices, the growth rate of output quantity. So the percentage change in M, that's the money supply growth, plus the percentage change in V, velocity, equals the percentage change in P, that's inflation that we've been talking about, and the percentage change in Y, that's the change in real output. This is insightful, this equation right here, because what it tells us is this. If we believe that, I should look over here, if we believe that this is relatively stable, the number of transactions that are used in a given year, how often money turns over. And if we look at the Y here, the change in real output is being relatively stable. And that's why I put these bars over it to mean stable. Then really what you see is this connection between growth in the money supply and growth in inflation. So before we go further, let's look at this. Let's look empirically at how we know this works, the relationship between money supply growth and inflation. Well, I'll give you two examples. Let's rewind to the 1920s in Germany. We know Germany started World War I, and it couldn't pay for the war that it had started, so it started to borrow money, and it borrowed money under the pretense that when they win the war, they're going to take over countries and extract the resources out of these countries, and they'll be able to pay back the bonds. I need to be clear here. When I say Germany borrowed money through issuing bonds, that's accurate on the surface, but the bonds were purchased by the central bank of Germany, which paid for them by issuing reserves that eventually increased the money supply. And so that's how they wanted to finance the war. And so they financed the war that way, but they lost and never got those resources to pay off the bonds. So that was a problem in and of itself. The other problem was the rest of the world got after Germany and wanted restitution basically for destroying their countries in a war. And so Germany was forced to pay restitution to the rest of the world, and that was a huge amount. So if you look at the cost of the actual war that Germany had financed, plus the cost of destroying various countries, Germany could not pay for that. So what did they do? Well, they basically started up the printing presses. And so I'm always careful about talking about starting up the printing presses because that's what the general media talks about with the Fed. And the Fed is not bringing up the printing presses because the Fed is independent of the Treasury in this country. We're talking about countries when we look at hyperinflation, which is where I'm going with this, is we're looking at countries that their government and their central bank are not independent. And so Germany started up the printing presses, and before you knew it, their inflation was super high. And so you can see that, look, if you have really high money supply growth, it's going to lead to high inflation. The idea is that, look, this velocity can't change that much. So you can grow your money supply like in the thousands of percents and have an inflation rate in the thousands of percent. But you can't really change how often you and I do transactions. That's kind of hard to boost up into the thousands of percents. So this kind of is not an issue when you have hyperinflation. And then the real quantity of output, well, that probably actually falls. Think about it. So what can individuals on a day-to-day basis, how much can they produce or not produce? It doesn't change a whole lot. So when you have examples of hyperinflation, you're pointing to these two variables in this equation. So that was the 1920s. And by the way, it took Germany all the way to 2010 to pay off that bill to the rest of the world for World War I. Now, in today's world, right now, there is Zimbabwe. And Zimbabwe just recently had inflation rate of 79 billion percent. 79 billion percent. So obviously the velocity that people who are transacting has not changed by 79 billion percent. And the output that they can produce, the goods and services, I don't think it's changed by that amount. I think it's pretty much these two variables highly connected in a hyperinflationary world. So now, what about in a mild or normal inflationary environment, kind of like what we have now? What's the relationship between the change in the money supply and inflation? Well, that's where things get murky. If this is only changing by, these two items are only changing by a couple of percent, the problem is that velocity of money is also changing. It's changing a few percent at a time. And output's changing at a few percent at a time. So what happens is this connection between these two variables becomes disconnected. That disconnection causes us to think a little differently about how to look at this equation. And one way to look at this equation is to realize that, look, money supply equals money demand. And so here we're denoting, normally, by the way, when we just have M, we mean money supply equals money demand. We're not really differentiating between the two. But here we need to differentiate between the two. So I'm going to put a little superscript S for money supply equals money demand, with a little D up here. In equilibrium, this holds. So the point is, well, why don't we, not only in this equation, but actually look at this equation for a second and say, look, what about money demand times velocity equals GDP? Maybe we could better understand what drives velocity, because velocity, like I said a moment ago, it changes by a few percent, but what causes it to change? Well, maybe if we have a better handle on money demand, we can better figure out what drives velocity. And so the reasoning is, look, if you just rearrange this slightly, you get this equation, which basically says money demand is proportional to the amount of GDP that you have, nominal GDP. It's proportional, and that's what that equation tells us. So now what we want to do, let's look closer at what drives money demand. Now what I want to cover is the velocity of money and its connection to money demand and money demand drivers. So I've organized the relationships on this one slide. It's kind of busy. Don't lose me. I'll go through it piece by piece, and we'll have a much better understanding when we get done of the relationships that are going on here. Before we go further, look at the slide here. There's actually three sections. One is transactions demand, where we're going to use money to facilitate transactions. And then there's drivers that are non-transactional demand, and we'll cover those. And then I bordered everything with a red line that shows inflation just by itself and its effect on velocity. So let's start off and with transactions demand. And first thing we see is nominal income. Okay, that's nominal income reflects inflation essentially, the current price level. And what we see is when your income goes up, your money demand goes up. And that kind of makes sense. The more money you earn, the more likely you're doing transactions. Or you're going to need money to perform transactions. We assume that there's no effect on velocity of money. So the number of transactions that you're doing won't change. But your income goes up, you're going to hold more money, and maybe that's the size of the transactions, the dollar amounts of the transactions may be bigger. But from a velocity perspective, we're going to assume that there's no effect there. Now let's move to nominal interest rates. And when nominal interest rates go up, there's an opportunity cost of money associated with that. And so we're going to put our money, most likely when we have higher interest rates, into, for example, a bond portfolio, a bond mutual fund. And we're going to conserve on the amount of money that's either in our pockets or in our checking accounts. So remember, money demand represents how much money you want to hold in your pocket or in your checking account. And when interest rates go up, the opportunity cost associated with keeping money in your pocket or in a checking account, that goes up. So what do? You lower your demand for those money. You lower your balances for that money, and you move it into a bond fund. Now, when you have lower balances in your checking account, all else being equal, it's going to imply that your velocity of money is going up. You have lower balances, and you're going to have to turn that over more frequently. Now, the next item in transactions demand is financial innovation. We normally think as financial innovation is growing over time, it's increasing, so it makes sense we have an up arrow here. With nominal income, by the way, and nominal interest rates, I mean, those can go down for sure, and so the effects will be the opposite. Just move the arrows in the opposite direction. But financial innovation tends to be on the positive side. So we have an up arrow, and what does that mean here? It translates into money demand falling and velocity going up. Let me explain with an example. Over the years, financial institutions like mutual fund complexes that offer literally hundreds of mutual funds. They offer money market mutual funds. They offer stock and bond mutual funds. And now that we're on the web more and more, you can manage your portfolio on the web, and you have access and the ability to transfer money back and forth between those accounts. So that's an innovation. And what it does is it allows you to conserve on the amount of money that you hold, meaning the amount of money you have in a money market mutual fund and even in your pocket in a checking account. So what that does is it means your money demand your balances are dropping off, and it allows the velocity of money to pick up. You can conduct more transactions. And it's easy. You just wire money back and forth between your accounts. So that's what we mean by financial innovation. Now let's move on to precautionary money demand. When that goes up, money demand goes up, and the higher balances cause velocity to drop. So what is precautionary money demand? Well, it's money you hold in your pocket because you can't forecast what's going to happen and things are uncertain. So you tend to hold a fair amount of money in your pocket because of that. And so you hold that higher money balance, and your velocity of money is likely to be lower, all else being equal, less transactional demand from that. And so I have it here, the precautionary money demand goes up, and we see the relationships. But precautionary money demand can actually drop. And you might ask, well, how would that be? Well, it's connected to financial innovation. So think of lines of credit. So people and many businesses have lines of credit. That means you have access to funds, immediate funds, if you need them. So you don't actually have to hold money in your pocket or in a checking account at the time. If you run into problems, you're just going to draw down on that line. And so you can see that innovation and precautionary money demand actually ties together. But the point is, let's go back to the slide here. Precautionary money demand goes up. We naturally would hold more money, and our velocity of money, the transactions we're going to do with that higher balances, we're going to slow down. Now, let's look at non-transactional demand. And so the first one, and so by the way, you see that transactional demand and velocity are deeply connected here, right? But when we get the non-transactional demand, it makes sense that velocity, there is no V's here. There is no velocity impact. At least that's what we're assuming. So the first item is when wealth goes up, when we're wealthier, not necessarily income, this is wealth. Stocks, bonds, that's wealth, alternative assets, and also, how much real estate you own. When you're wealthier, you're going to have a higher demand for money. Doesn't necessarily mean that you're going to have more velocity, but this just means you're more likely to hold more money in your checking account or in your pocket. Now, let's look at alternative investments. And the easiest way to think about this is a higher yielding bond portfolio, say a mutual fund. Okay? So when returns on these alternative mutual funds, these alternative assets like a mutual fund goes up, then our money demand is going to drop. We're going to take money out of our checking account and put them into those bond portfolios. So we just shift money over, our money demand will be lower. And the same thing now here with risk. I shouldn't say the same thing, but when risk goes up of those alternative assets, we're going to want to move out of those assets and into cash and into checking accounts or cash in your pocket. That makes sense. Now, if the alternative assets increase in liquidity, then our demand for money is going to drop off because, wow, we can actually put our money in a bond fund, which is not in the definition of M2, for example, that money aggregate M2. Then what will happen is we'll have less money in our pocket and less money in our checking account. So money demand will fall off under this situation. Now the next one is a little tricky. It's the expected future interest rate here that we want to look at. And so expected future interest rates, if they go up, then money demand is going to go up. Think about it this way. If you expect interest rates to rise in the future, what you're going to do is you're going to pull your money out of those alternative accounts, like a bond fund, because you're going to experience a capital loss because you know that when interest rates go up, bond prices drop, even stock prices drop. So the alternative asset could even be a stock mutual fund, for example, or plain old stock. So when expected future interest rates go up, money demand is likely to go up. You're going to go into a nice, stable checking account or cash and avoid those capital losses. Now, let's hit that red line and look at inflation all by itself. So now, inflation is built into nominal income and nominal interest rates if you look further up in this slide. But let's keep it as a separate item here and look at the effects of what happens when inflation goes up. So when inflation goes up, velocity goes up. Now let's take a look at that carefully. And one way to look at it, and it's what I like to do in a lot of my classes, is we come to a relationship. Sometimes it's very helpful to go to extremes. And when you go to extremes, you can take something to infinity or take it to zero and then see what the model implies. Well, here what we want to do is let's look at the concept of hyperinflation. And I've talked in the past about hyperinflation, and let's assume for a moment that inflation is 79 billion%. And that's the inflation rate that Zimbabwe has had in recent years. Now, I don't know if that measure is on an annual basis, but I'm just going to assume that the 79 billion% is, let's just say it happened over half a year, as an example. So if you translate that into a daily increase in prices, what that really boils down to, believe it or not, is about almost 15%. 15%, actually 14.78% gain in the price level every day. So if you take 1.1478, take it to the 182nd power, so let's assume there's 182 days in a half year, subtract 1 and multiply by 100, you'll get 14.78%. So you think, wow, okay, well, that's not too bad, 14.78% per day, but that's just an assumption. That's an average. I mean, think about it. If you're in the real world and that's happening to you, you really don't know what's going on with the price level. You really don't know. You're guessing. And we're assuming here that it rises by about 15% per day. It could be quite choppy. And so it's a highly uncertain environment. So you wake up in the morning with some cash in your pocket. What are you going to do? You got to go down to the market and you want to buy something. Well, by the time you walk to the market, prices could have gone up 5%, meaning you're paying 5% more basically for the same goods with the same amount of money in your pocket. So what happens when there's really high inflation is people want to get rid of their money as fast as possible. So the velocity of money picks up very quickly. You just don't want to hold money. You want to convert it into a real asset that you can get value out of. Now we get to the more interesting part of this chapter, and that's modern monetary policy. So we're now at a point where we've just covered a whole lot of material, and we need to translate it into something useful. And so what I mean here by monetary policy is what kind of policy should the Fed have when it conducts monetary policy to keep the economy growing nice and stable? Well, before we actually get to that, let's draw a graph that'll help us with that analysis. Here we have the nominal interest rate, right? From the Fisher equation, it's the real rate plus inflation. And we're going to put the money supply here, M. So this, this axis here would be the quantity of money that's out there. And this could be like, $1 trillion, for example. And then we'll have money demand here. We'll put a little d in this book. So here we have money demand, and that money demand is for a given level of output. In other words, nominal GDP. And so here we have an equilibrium. And remember what happens when we change what's on this axis. We move along the curves. And so when interest rates are high, for example, and we're up here, that means quantity of money demanded will be low. And if interest rates are low, then the quantity of money will be higher. And that's the opportunity cost, the inverse relationship between money and opportunity cost. So when you're up here with high interest rates, you don't want to hold money, because you're not going to earn anything with money in your pocket or in a checking account. You'll want to put it into a bond fund, for example, that earns a decent rate of return. Okay, so keep in mind now that when things other than I, the nominal rate, changes, then this money demand curve will change. And so that's what we looked at. We looked at the transactional motivation for that. And we said, for example, if income goes up, nominal income, which is kind of like GDP. Remember, gross domestic product. The flip side of that is money spent on consumption, investment, government expenditures, and net exports equals somebody's income. And so if income goes up, the money demand goes up, as we said it a little while ago. And that kind of makes sense, because if we hold everything else constant and this goes up, money demand goes up because of the change in GDP, well, that just means people want to hold more money. It's the price of money. It's going to go up. It's going to go to a higher interest rate, and we could move up in this direction. Or if income fell, nominal income fell, we'd have a lower interest rate. We'd move here. Now you can see from this graph and our discussions in this chapter, there's actually two ways to conduct monetary policy. In other words, if you wanted to recommend a policy to the Fed, what would you do? Would you want to keep the money supply here growing at a nice constant rate? And so growing at a constant rate would mean, look, you have a new money supply here after a period of time, and this would be, a certain percentage. I mean, this is measured in dollars here, but for a certain percentage of change in money supply. Would you want money supply to grow at a nice gradual pace, kind of like what I talked about when Milton Friedman said, look, want the economy to grow like this, then you keep the money supply growing at a nice stable rate. Do we want to focus on the money supply? Or the flip side, let me get my red marker here, is what if we were to instead focus on keeping a nice stable interest rate? What would be better? A stable interest rate or a stable growth rate in the money supply? We have an answer to that. We actually covered an answer to this issue. Recall that we said that money demand is kind of unstable. And it's unstable because velocity is unstable. We talked about it being hard to predict, and mainly in the short run. So volatility or velocity, changes over time, but in the long run, it's relatively stable, predictable. But in the short run, it's going up and down. It's hard to predict these changes. So that kind of gives us an answer as to which policy we should pick, because let's go here. Let's go to our graph and say, okay, let's for simplicity, we'll keep the money supply. Pretend this is growing a little bit. It's relatively stable. It's going to grow. When it grows, it inches out slowly to the right, over time. But let's, for a short run, keep it constant here. And since we know that money demand is unstable because velocity is unstable, what it's saying is, look, velocity is not in interest rates. It's not an interest rate, so it's something other than an interest rate. It's causing money demand to go up and down. And so if you were to focus on keeping on money supply fixed, with money demand jumping around, interest rates would jump around a whole lot. And so you would see interest rates continuously changing in the economy, and that would be very confusing and unsettling to a lot of people. Interest rates are advertised everywhere. You see them in newspapers, you see them discussed on television, on the radio, on the internet. Everywhere you look, interest rates are disclosed and discussed. And if you see volatile interest rates, it kind of scares people. So that kind of doesn't make sense. You don't want interest rates jumping all around. Okay, so that means, the old Milton Friedman, remember I said the Milton Friedman argument was in the 50s, I said, look, he wanted this to happen and the money supply to grow nice and stable. And I said, that was good a long time ago, but the world's a lot more complicated and things have gotten more complicated with financial innovations, sweep accounts and other things like mutual fund complexes that have allowed money to move back and forth. Money demand can be quite unstable and velocity unstable at the same time. So why don't we look at what if the Fed, so here's the equilibrium interest rate, why don't the Fed just keep, for example, interest rates at this level here? And if we keep interest rates at this level, at least in the short run, what would happen? Well, I'll tell you what would happen. We keep interest rates nice and steady, and what you would see is, money demand would go up or down. So here's money demand going up, right? Well, what the Fed could do, get some marker here, is if money demand went up suddenly and unexpectedly, it could increase the money supply, right? And move it out to keep interest rates at this nice, stable I star. Or vice versa. If money demand drops, money supply would move off to the left. So what the Fed can do is could adjust the money supply to counteract the changing money demand, that the unpredictable component of changing money demand. Money supplies is, it is made public by the Fed. You can get it off the Federal Reserve's website, but it's kind of behind the scenes. People don't really keep track of that. It's not advertised all over the place and in a lot of, it's just not discussed. It's kind of behind the scenes, whereas interest rates are really much more important and in your face because, you want to borrow money for a mortgage. You're wondering, well, what's the interest rate? You're not asking, I wonder what happened to the money supply last week. You don't care what happened to the money supply. You're worried about what's the cost of money. So a stable interest rate and a stable price of money is important. So the point is, we covered this. We started off with this equation. Okay, we started off here, and what we spent some time in trying to spin around with this. We looked at it a whole bunch of different ways. We could say money equals this, right, where you say, okay, money is a function of velocity and GDP, or we could have wrote it, look, velocity is a function of GDP divided by money, and so on. And we could rearrange this. And what happens is you get lost in the analysis, and you ask yourself, well, what's driving what? Does velocity drive money and GDP drive money? Or is it money driving velocity? So you kind of get confused in the direction of things. And really the answer is it's all done simultaneously. All these things are interacting at the same time. So now the point that we're at now in this chapter is, look, it probably makes most sense to stabilize interest rates and let the money supply jump around behind the scenes. And that's basically where we're going in the next chapter. So the next chapter is about how do you actually implement monetary policy? Well, the policy should be stabilize interest rates. And the only time, so stable under normal conditions, stabilize interest rates. And then we can use interest rates as a policy tool, as a discretionary tool. And what that means is, Look, when we think we're going to go into a recession, we drop interest rates. So we had a steady interest rate here. We're going to drop it if we foresee a problem. And if the economy is overheating, we can raise the interest rate and move it up. But at least it would be fairly steady when the economy was fairly steady. So it looks like we have a solution to the problem. And now we need to just look at this more closely. When the Fed changes interest rates, right, we need to ask, well, when is it going to change interest rates? What's the driver behind that? And how does it affect aggregate demand? In other words, demand in the entire economy. How does it affect aggregate supply? And what are all the implications? Again, that's what the next chapter summarizes nicely.